Okay, so we are working on chapter 14, the strategy and the balance scorecard. So this video focused on the strategic analysis of operating income. So this analysis will be involved with three parts. So growth component, price recovery component, productivity component. Okay, so right now you probably don't know what this is doing. So basically, I have a company. So you have comparative figures between 2 years, 2021 and 2022. And so in this example, we can see the operating income has increased by $134,000. So we say this is a favorable variance. So we want to understand what caused, right? What caused this increase in the operating income, right? So we are doing a strategic analysis. So basically, this can be broken down into three components. So one is called a growth component. Okay, this growth component have revenue effect and the cost effect. And also, obviously, you think about the growth, this is really about the sales volume. Right? The price recovery component has effect on revenue and the cost. So this is really about the price, right? The input price, right? The selling price. And then the last one is productivity component. This is related to how efficiently the inputs materials, right? The input sources are used. So in this case, we're gonna be able to explain that income increased $134,000. Where does that favorable increase coming from, right? From growth, price recovery, or productivity component. So this will tell us more information, and the managers can, based on this analysis, to make decisions. So let's first take a look at the growth component. So growth component measures the change in operating income attributable solely to the changes in the quantity of output sold between the current and the prior year periods. So this component capture the changes in the income solely due to the change in quantity of output sold. Okay, so we have formulas for the effect of this growth component: revenue effect, cost effect for variable cost, and also two formulas for fixed cost, depending on whether the capacity is adequate. Okay, as we know that fixed cost is related to the capacity, right? The higher the fixed cost, you have more capacity. So in this case, we are saying, well, if we assume there is enough, there is adequate capacity, you're going to use this formula. If there's inadequate capacity, you use a different formula. Okay. So I will go through the formula once we are going through using that example, right? So this is an example. We're comparing 2021, 2022. 2021 is the prior period. 2022 is the current period. So we can see units of work performed, 60 versus 70. Selling price, a little bit decrease, 50,000 to 48,200. Software implication, labor hours, right? This will be the variable cost. Labor cost will be variable cost. Labor hours, 30,000 to 32,000. Cost per software implication labor hours. So how much does the labor cost per hour. So $60 versus $63. Software application support capacity. Okay, so the support capacity here is 90 units in both periods. So this kind of tells me that there is enough capacity, right? Because this is 90, right? So because right now your work performed is only 60, 70, so it's still under 90. So I would consider this to be the scenario where there's adequate capacity. The total cost, the software application support, this is support cost, is 360,000, 369,000. The software application support capacity cost per unit of work. Okay. So now if I think about the cost is 360,000. So the capacity unit is 90. So for each unit, it's 360,000 divided by 90, so it's 4,000. And in this case, 369,000 divided by 90, that's 4,100. Number of employees doing software development, so 3 people, no change. Total software development cost, 375,000, 390,000. So the cost per employee is 375 divided by 3, 125, 390,000 divided by 3, 130,000. Okay, so these are the information. So now let's take a look at how we're gonna figure it out, right? The different component using the formula. So for gross component, so I want to see what is my revenue effect. So my revenue effect of the gross component is to use current period sales minus your prior period sales, right? And times prior year's selling price. So I use 70 current year sales minus prior period sales, 60, times prior year's selling price. Okay, so that's the formula here. Actual unit of output sold in current period minus actual unit of output sold in prior period times selling price in the prior period. So I get $500,000 favorable because I'm able to sell more, right? Which is good news. Because when you sell more, this revenue, right? You have more revenue, that's a good news. So this is a favorable, 500,000. Cost for labor cost. The labor cost is variable, right? Let's take a look at the equation. Cost the effect of growth for variable cost, which is labor cost is variable cost. So they use units of input required to produce current output in the prior period minus actual units of input used to produce prior period output times input price in the prior period. So the input price, which is the labor price, right? $60 per hour, right? And then the actual unit of input in the prior period. So the actual input is how much labor hours spent in the prior period. And then the units of input required to produce current output in the prior period. So this tells me that how much labor hours will be required in the prior period to produce current output. Okay, so here my prior period price, the labor cost rate, right, is $60. And the input labor hours in the prior period is 30,000 hours. The input hours required in the prior period to produce 70 units, the current period output, is 35,000. So someone will say, well, I can see here is the 32,000, right? 32,000 is the actual input for the current output in the current period. So the formula is asking the unit of the number of the labor hours required to produce 70 current output, 70 units in the prior period, okay? So in the prior period, I need 30,000 hours to produce 60 units. In order to produce 70 units, I would need 35,000 hours, right? Because you can see 60 units for 30,000 hours, 70 units is going to require 35,000 hours. So I use 35,000 hours minus 30,000 times prior year's rate 60. So this one equals $300,000. Okay. This is a higher cost, right? The cost is higher, so it's unfavorable. So this is a variable cost. And now there are still the support and development costs left. These are fixed costs, right? So for support cost, so let's take a look at the fixed cost. So there are enough capacity in this question, right? The 90 units is adequate, right? Because the current period only sells 70 units. So there's adequate capacity. So we're going to use this formula. So actual units of capacity in prior period to produce current period output. So that's 90. Actual units of capacity in the prior period. Okay, so this is 90, right? This is both 90 times price per unit capacity in the prior period. So 4,000. So I use 90 minus 90 times 4,000. That equals 0. And then cost of growth for development cost is the same idea. The capacity is 3 employee, and then minus prior years is also 3 times the rate of the cost is 125,000 per employee. So that's 0. Okay, so I'm not requiring you to memorize all these formulas. Okay, it's a lot of things to memorize, right? So so if there's a question like this in the exam, maybe you should be prepared to write these formulas to your cheat sheet. Okay. So this is my growth component. Now let's take a look at the price recovery component. So price recovery component measures the change in operating income attributable solely to the changes in price of input and output. So your input price, output price has changes. So that would have effect on the cost and the revenue. So again, we have formulas for revenue and formulas for variable cost, and 2 formulas for fixed cost, depending on whether there's adequate capacity. So in this case, the revenue effect on the price recovery, so you use the current price, current selling price, minus prior period selling price and times the current output 70. Okay, so you have 126,000 unfavorable. The reason why it's unfavorable is because your selling price is decreased, right? So that's your revenue effect of the growth. Sorry, not the growth, revenue effect of the price recovery. Okay. Okay. So revenue effect of the price recovery. Okay, now let's take a look at the cost effect of the price recovery for labor cost, which is variable. So you use current price 63 minus prior period price 60. So this is the cost per labor hour, and times here is the number of units required to produce current output in the prior period. Okay, in the prior period, you used 30,000 labor hours to produce 60. In the same period, if you need to produce 70, you're going to need 35,000 hours. So that's why we times 35,000. The reason is here, okay? So you can see the formula for cost effect of price recovery for variable cost is input price in current period minus input price in prior period times units of input required to produce current period's output in the prior period. Okay, so it's in the prior period. So you have to proportionally calculate, right? Calculate what is that units of input required. And then cost effect of price recovery for support cost. In this case, it's the fixed cost. So there is enough adequate capacity. So use price per unit capacity in the current period, price minus price per unit of capacity in prior period, times actual units of capacity in the prior period. So price period is 4,100 minus 40,000 times the capacity in the prior period is 90. So you have a $9,000 unfavorable because the cost per unit of work, support cost per unit of work is increased by 100. So it's an unfavorable variance. So same idea, you use current price, 130,000 per employee for development cost, minus 125,000 development cost per employee, times prior period capacity 3 employee. So again, because the per employee cost increased from 125 to 130,000, therefore it's unfavorable. Okay, so this is my price recovery component. The last component is the productivity component. This measures the change in cost attributable to a change in the quantity of inputs. Productivity, this is related to the cost. So therefore, this component has no effect on revenue. Okay, so this component only have effect on cost, variable cost and fixed cost. That is attributable to the change in the quantity of inputs. So you have two formulas for fixed cost depending on the capacity and one for variable cost. So let's take a look. Cost effect of productivity for labor cost. So you use 32,000. This is the actual cost in the current period, minus the input cost of the unit required to produce current output in the prior period, which is the 35,000 labor hours times current year's labor hour cost, 63. So in this case, your cost is lower, right? You use less hours. You compare to the prior year. In prior year, if you produce 70 units, you would need 35,000 labor hours, but the actual hours is only 32,000. So you save some labor hours. You have more productivity. So this cost is favorable. And for the fixed cost, we are saying actual units in capacity in current period, which is 90, minus actual units in the prior period, which is 90, right? So 90 minus 90 times current rate, 41,100, so it's 0. So current 3 minus 3 times 130, 130,000, that's 0. Okay, so the idea is when you were given this information, you need to use these formulas to figure out the difference. Okay. Excuse me. And I know it's quite a bit to memorize, so I'm not requiring to memorize it. I just want you to know the formula, practice with it, and in the exam, you know how to use it, right? You know how to use it. So you have to know which information to use, right? Are you using the current or prior period, right? Are you using the actual units, or you are using the units that would be required to produce current output in the prior period, right? So maybe it took a little bit of practice, do a few questions to get your mind around this. What does these formulas mean, right? Okay, so then when you pull everything together, right? So you can see growth component, they have effect on revenue and cost. Price recovery component has effect on revenue and cost, and the productivity component has effect only on the cost. So then it tells me that your growth component has a $200,000 favorable variance. So that growth is good, right? Your productivity component tells me that your productivity is good because you have a 189,000 favorable here, cost saving. Your price recovery component is not so good because you have a $250,000 unfavorable difference. So this tells me that the prices of input probably has gone up, and the prices of the output, right, your selling price is probably going down, right? But altogether, right, you have a good result. Okay, you have a good result. So now, as a manager, right, I'm able to see what consists of this $134,000 income, right? The business is growing. That means I'm selling more, right? 60 units to 70. So that's a good news. And you are more effective, right? You use less labor hours, right? And then you are more productive, but the price is against you, right? So this is very useful, as you can see. So I hope this makes sense. Let me know if you have any questions. Okay, have a nice day.